You've saved your first $5,000. Now what? Today, I'll show you exactly how to invest that money in the stock market, step by step. Getting started is the most important part. Building wealth isn't about risky schemes. It's about starting early, being consistent, and letting compound interest work for you. That $5,000 can grow into something substantial, but only if you put it to work. The key isn't timing the market, but time the market. We'll cover setting your goals, building an emergency fund, choosing a brokerage, diversifying with index funds or ETFs, and staying consistent for long-term success. Let's dive in. Before you invest, ask yourself, what are you investing for? Without a clear goal, you're just throwing money into the market. Your goals shape your timeline, risk tolerance, and investment choices. Are you saving for a house in 5 years? Or retirement in 30? The timeline is critical. If you need the money soon, you can't take big risks. If your goal is decades away, you can ride out market ups and downs. Write down your top financial goals, the amount you need, and your target date. For example, down payment $50,000 5 years, or retirement $2 million 40 years. This gives you a concrete target and helps you understand your risk tolerance. For this video, let's assume your $5,000 is for a long-term goal like retirement. Long-term investing lets you take advantage of market growth and compound interest. With a long-term mindset, you won't panic when the market dips. You'll see it as a buying opportunity. Your written goals become your North Star, keeping you focused when markets get volatile. Define your why before you get into the how. That's your foundation. Now, before you invest, you need an emergency fund, your financial safety net. Don't invest $1 until you have 3 to 6 months of essential expenses saved. This fund is for true emergencies, job loss, medical bills, car repairs, not vacations or gadgets. Calculate your monthly essentials, rent, groceries, utilities, insurance, and multiply by 3 to 6. Keep this money in a high-yield savings account, not the stock market. Your emergency fund preserves stability. Your investments build wealth. If you lose your job during a market crash, you don't want to sell investments at a loss. If your monthly expenses are $1,500, aim for $4,500 to $9,000 saved. If you don't have an emergency fund, use your $5,000 to start one. Only invest what's left after your emergency fund is set. This step gives you peace of mind and keeps you from making desperate decisions. It's not flashy, but it's essential. Don't skip it. With your emergency fund in place, it's time to open a brokerage account, the gateway to investing. Look for a brokerage with zero commission trades and no account minimums. Most major online brokerages, Vanguard, Fidelity, Charles Schwab, fit the bill. For beginners, a Roth IRA is a powerful tool. You invest post-tax dollars and your growth and withdrawals in retirement are tax-free. The contribution limit is $6,500 per year as of 2023, so your $5,000 fits perfectly. You can withdraw your contributions anytime, but earnings are locked until age 59 and a half. Open a Roth IRA at a reputable brokerage. Vanguard, Fidelity, or Schwab are all great choices. Their platforms are reliable, low-cost, and beginner-friendly. Don't overthink the choice. Just pick one and get started. The process is simple. Go online, open a Roth IRA, fill in your info, and transfer your money. Don't let indecision hold you back. The most important step is to take action. Your future self will thank you. Let's move on to what to buy. Your account is funded. Now what do you buy? Skip picking individual stocks. Even the pros rarely beat the market. The smarter move is to buy the whole market through index funds or ETFs. An S&P 500 index fund lets you own a piece of 500 top US companies in one purchase. Instant diversification. If one company fails, it barely affects your investment. ETFs work similarly, but trade like stocks throughout the day. For long-term investors, both are excellent. Look for funds with ultra-low expense ratios, ideally under 0.10%. Great options: Vanguard's VTI, Total Stock Market ETF, Fidelity's FZROX, or S&P 500 funds like VOO or SWPX. With $5,000, you can buy into one of these broad market funds and instantly own thousands of companies. Log in, search the ticker, and buy your shares. You're now a diversified investor. It's simple, effective, and stress-free. That's the power of index investing. You've made your first investment. Congratulations. Now, the real secret: consistency. Don't obsessively check your portfolio or react to every market swing. The best strategy is to buy, hold, and keep adding money regularly, no matter what the market's doing. This is called dollar cost averaging. Invest a set amount each month, rain or shine. When prices are high, you buy fewer shares. When prices drop, you buy more. Automate your investments so they happen without you thinking about it. Ignore the noise. Emotion is your enemy. When markets drop, don't panic sell. When they soar, don't chase FOMO. Stick to your plan and remember your long-term goals. Even small, regular contributions add up over time. Check your portfolio occasionally, not daily. Let your money work in the background while you focus on living your life. Consistency and patience are what build real wealth. That's it. A simple, proven plan to invest your first $5,000. Set clear goals, build your emergency fund, open a Roth IRA, buy a diversified index fund, and stay consistent. It's not about luck or timing, it's about starting and sticking with it. The earlier you start, the more powerful compound interest becomes. Take your first step today. Your future self will thank you. If you found this helpful, hit like and subscribe for more personal finance tips. Thanks for watching, and I'll see you in the next video.